afternoon, everyone. Thanks for joining us for What Makes a Plan Qualified. I have just a few announcements. For those of you who are requesting credit, please note to receive CE credit, you must remain logged into the video portion of the webinar for the entire program. Logging into the audio portion only is not sufficient for CE credit. Continuing education credits are being offered for the following designations: CPE, CIMA, CPWA, CIMC, RMA, CFP, and SHRM. Also, at the end of the webinar, we would like to request that all attendees fill out the evaluation form that will pop up. If you have any questions during the presentation, please submit them through the question box. At the end of the webinar, we'll answer as many questions as we can, but we want to be respectful of your schedule and end on time. If we don't get to your question today, we will definitely follow up with you afterwards. Tomorrow, you will receive an email with a link to replay today's broadcast. So let's get started. Our instructor today is Mary Reed, Pentegra's National Director of Pension and Protection Planning. Mary is a specialist in qualified tax advantage strategies for small business owners. She helps those business owners turn a good year into a great year by keeping them more of what they've earned. Mary, I will hand things off to you.
All right, thank you very much, and welcome everybody. So let's dig into the material today. Our objective today's session is on what makes a qualified plan. So we're going to dig into some of the nitty-gritty of the rules that have to be followed. So we'll also talk about the benefits of a qualified plan and differentiate between what makes a prototype plan versus a custom plan. We know there are both types, but a lot of people are not clear on what those differences are. We'll talk about understanding the plan provisions and what are required. There are lots of requirements about what actually has to be in the plan, and then there are those optional provisions that the employer can also choose. Then we'll go through kind of briefly all the various types of qualified plans and the basic rules around those, and how much you can actually contribute to each type of plan. So that's our agenda for the next hour. It's a lot of material, but we'll get through it. So let's start right at the beginning, qualification and tax benefits. Well, what is a qualified plan and why does everybody do it, right? A qualified plan is a plan that an employer can adopt, and this is an advantage only for business owners, right? If I'm just a private individual, I can't do this. It's a retirement plan for employees at its base. That's the reason why the IRS lets you take a deduction for the money that is put in there. If you think back, some of these plans were created back in the Depression. It was a way to enable you to retire your employees. And so it's an employee benefit program in the IRS's eyes, and therefore you get to take deductions for the contributions that are put in for the employees. What makes it qualified is following the rules that the IRS and the DOL have put in place to be able to do that. So all qualified plans must meet certain requirements. If they do, those contributions will be deductible. They will not be currently taxable to the participants. Someday in the future, when they withdraw the money and spend down the money, then they will pay the tax on the distribution. But until then, no tax will be paid. So what are the requirements? So that's what we're here to talk about. So first of all, let's start with the plan has to be a written plan. This cannot just be some general statement by the employer. It has to be a written formal document. That document has to conform with provisions of the Internal Revenue Code. There have to be certain provisions in that document. There has to be certain language. The terms of the plan have to be consistent with the current laws and regulations. Once we get past just writing that plan, we have to comply with what the plan says. You actually have to operate the plan in compliance with those laws. And then there are reporting and disclosure requirements to go along with that, to track that and report to the IRS and the Department of Labor, and then disclosures also to the employees. Now, if those things are not followed, what can happen to the plan? Well, if they're not followed, the plan can fall out of compliance and be disqualified. So if the plan were disqualified, you no longer have a qualified plan. Therefore, all those deductible contributions may no longer be deductible. That employer may lose those deductions they had taken. The vested benefits that are in the plan may be immediately taxable to those participants because we don't have a qualified plan deferring them anymore. And then there could also be penalties that are assessed by both the Department of Labor and the IRS. So disqualifying a plan is a very bad place to end up with. If you think about a plan that might have been around for some time, that employer might be forced to undo years of deductions on their tax returns. That can be quite an expensive undertaking. And so that's why it's important that these plans are administered. That's why there are third-party administrators to administer these plans and make sure that all the rules are filed and the plan is kept qualified and in compliance. So some basic rules. Rule number 1, the plan document language must be up to date at all times. You cannot write a plan document once and have that plan in effect for years and years and years and never amend it. Those documents have to keep up with changes in the rules. And the plan language must be followed in the actual operation of the plan. That would be considered a plan failure if the plan states one thing, but the operation of the plan is doing another. Failure to follow these rules could result in penalties. There are compliance programs where the employer can go to the IRS and plead their case and get penalties and fines and maybe fix it, or it could lose to plan disqualification in really severe circumstances. So we talked about documents. Let's talk about documents for a minute. The plan documents are originally written to create the plan, but then over time they will require amendments. They will need to be updated and amendment to keep up with changes in the rules, right? Pension law is always changing, and periodically those changes have to be written into the plan documents. Sometimes the changes are elective. Sometimes it's something the employer is choosing to make a change with. That would also require an amendment. But in either case, amendments are important to keep that plan document up to date with legislative changes, regulatory changes, but also with the desires of the employer and how they want to operate that plan. This is a very common failure of employers, failing to keep their plan document up to date. This is one, when the IRS were to come in and do an audit and discover this, this is a real issue for employers, but it's a very common failure of plans. So here we've got the first question, so I'm going to turn it back for the polling question.
Thank you. Everyone, you should see your polling question displayed on your screen. I'm going to leave this question up for about 45 seconds to a minute for everyone to have a chance to select an answer. I'm going to leave the poll up for about another 10 seconds, so anyone who has not selected an answer, please do so. The poll is now closed. The correct answer was D, all of the above. And Mary, you may continue.
All right, thank you. All right, so just to summarize what we talked about so far, we talked about the importance of keeping that plan qualified, having the proper plan document, keeping that document up to date, the tax benefits that come with having a plan qualified and keeping it qualified obviously are to the benefit of that business. It keeps the contributions deductible and prevents benefit taxation until the employee takes that benefit sometime at a later date. And we have to make sure that the plan document and all the language keeps up with that. All right, so let's talk a little bit more. What language do you actually have to have in that plan document to make it qualified? So we all know about ERISA, right? Everybody's heard about ERISA from 1974. So ERISA mandates certain plan language that must be in there to protect the plan participants. So that would include naming the fiduciaries of the plan, identifying funding procedures for the plan, issues of operation and administration of the plan. There'll be language in there about amending the plan and who has the authority to make those amendments. Distribution procedures, the forms of distribution, the timing of distribution, all will be defined in the plan document. The assets in a plan are held in a trust A qualified plan is a trust. That plan document that is signed to set up the plan creates a trust. That is what keeps that money segregated from the other assets of the employer and also non-taxable to the participants. So language that establishes that trust will be in the plan document. The document will spell out the participants' rights, what they have the right to information on, what benefits they have a right to, what distributions, what access, all those things will be defined in the plan document. And of course, like most legal documents, there must also be set forth in there a process to appeal if benefits are denied to a participant. So there'll be many other provisions in the plan document, but these are all mandatory, and you will see these in every single plan document. So when might you have to change that document? So if Congress makes a change to tax law or ERISA, that may require a change to plan language. You certainly have seen those over the years. It might be an operational, it might be some other legal change. One that jumps right to mind. We used to have retirement ages. We used to be able to have retirement ages sometimes in plans as early as age 55. That was changed quite a number of years ago, and you can't do that anymore. So it's a really simple one that's obvious to people. That required a document amendment to change it because now the youngest age we can use is age 62. That's just a little example of one of those mandatory changes that you might have. Also, the Department of Labor is involved here too, and they may change their regulations. There's certainly been a lot of talk about the Department of Labor over the last few years about fiduciary responsibilities and things along that line. Certain changes that might be made that come from the Department of Labor would also require amendments to the document. Usually when these changes occur, they will be summarized in the regulations. A certain amount of time will be prescribed that the amendments have to be done within, and all plans will have to be amended within those deadlines. Now, what about discretionary provisions? Also, there will be discretionary provisions. Just because the laws change and the rules change doesn't mean that the plan has to go to those rules. Sometimes they do. Some things are mandatory, like the retirement age I just suggested. But another common one, we're so used to safe harbor 401k plans now. For example, when they first came out with safe harbor rules, you weren't required to go to safe harbor. That was an optional choice. But if you chose to, you had to do a document amendment to do that. So there'll be optional provisions like that will now be put on the table that might not have been there before. The employer can make the choice about those options, but if they adopt them, then you need an amendment to bring them into the plan. So here we have our next polling question.
The polling question has now been launched, and you should all see it displayed on your screen. I'm going to leave the polling question up for another 15 seconds for anyone who has not selected an answer. Polling question is now closed. The correct answer was D, all of the above. And Mary, you may continue.
Okay, thank you. All right, so let's move off, the basic document issues and qualification issues and talk about some of the other factors that play into qualification. Who's going to be in the plan? We have set rules about eligibility. Who can we allow into the plan and who can we keep out? So eligibility can be as long as 2 years, that someone has to work 2 years for the company to come in. We don't see that provision used very often because if we use a 2-year eligibility, they're going to be immediately vested when they come in the plan. Vesting is the definition of ownership in the benefit, right? An employee vests in the benefit that's been accumulating for them in the plan according to a vesting schedule. The money is not theirs until they vest in it. So if an employee leaves before they're vested, they don't get to take the money with them. So if you use a 2-year service requirement to get in the plan, we have to shorten that vesting period. So more typically, we'll see 1 year of service, and that the employee has to be age 21. Now, an employer can always be more generous than these requirements, but they cannot be more restrictive. We could not, for example, say an employee has to be age 25 to get in the plan. The oldest age we can use is 21. But if we want to open up our plan to let in 18-year-olds, we can. We can always be more generous. That 1 year eligibility, by the way, is also required for 401k plans. They don't have the option to go to the 2 year. They must use the 1 year. Now, when it comes to years of service, we can also have a requirement that they have to work 1,000 hours for the year to count. So for employers who have part-time employees, the pension question, the qualified plan question is not are they part-time or full-time, but how many hours did they work? The dividing line is 1,000 hours. If someone works less than 1,000 hours, they don't actually have a year of service, and they would not enter the plan. If they have more than 1,000 hours, they have 1,001, they just got the year of service, and if they age 21, they will come in the plan. Now, recently that was changed for part-time employees in 401k plans. And a new rule was put into place a couple of years ago that if we have part-time employees, who are under that 1,000-hour requirement, but they're there for 3 years, so they're long-term part-time employees, they must be allowed to enter the 401k plan. This is specifically a 401k rule to make salary deferrals. Now, even if they're allowed to make salary deferrals, if the employer is also making a contribution to that plan, they don't have to contribute for those employees, but they do have to be allowed to defer. So you can see an example here. If we had someone who had at least 500 hours of service in 21, 22, and 23, but under 1,000, they would come into that plan in 24 and be entitled to make salary deferrals. Now, once someone's eligible, we don't actually have to let them in the plan. There are some automatic exclusions that we can use that we don't have to worry about. They're just kind of given to us. And then there are selective exclusions. So these kind of automatic ones, we can exclude members of a union, anybody who's a collective bargaining employee. Non-resident aliens, those would be 2 standard exclusions. We see those in lots of plans. Now, the employer does not have to adopt them, but these are kind of given ones, so they're usually there. But we could also exclude employees by other methods, let's say by class, by job classification, by job title, by location. Those are things you can do, but you cannot do them randomly because we still have participation coverage tests that we have to pass. But those rules say just because someone is eligible, we don't have to let 100% of our eligible employees into the plan. We can choose to exclude some of them so long as we don't go too far over the limit and we pass our participation test. So let's talk about contribution types. Let's not going to get too much deeper into eligibility. Let's talk about contribution type. So now an employee is in the plan, and this is going to vary by type of plan. Now, once they're in the plan, so if it's a 401k plan, they can make salary deferrals, but the employer can also make contributions. And they could come in the form of a safe harbor contribution, a matching contribution, an employer profit sharing contribution. In any plan other than a 401k plan, it will all be employer contribution. Those employer contributions in any plan can be on a vesting schedule. It'll vary by the type of plan in some instances, but there can be a vesting schedule. In all types of plans, there are what are called safe harbor designs. Those are kind of in-the-box designs that the IRS has given us where we know they will pass the testing. We can step out of those boxes and then have to do more testing. Doesn't mean the plan won't pass. It can, and that is where plan design comes into place. And then there are other miscellaneous provisions that can come into play in designing a plan. How is the money going to be invested that's in the plan? Do we want to allow the participants to direct the investment of that money, which is a typical scenario in a 401k, or the employer, the trustee of the plan, whoever the trustee is, usually it's the business owner in a smaller plan, it could be a committee in a larger, are they going to direct the investments? Do we want to allow the employees to have access to the money by taking loans, for example? And then insurance is another feature that can be added to a qualified plan. Rules permit the purchase of life insurance in a qualified plan under limited circumstances, also health insurance in a qualified plan. And the reason that employers might be interested in that is they're buying those insurances with pre-tax dollars, right? Which is a cheaper place to buy the coverage if you're looking for the coverage. But again, there are rules that control how much can be purchased. So there'll be rules that how much money, right? The limit of contribution that can go in depends on the type of plan. How that money is going to be invested, those are choices. And then we have to where the money comes out. So the money can come out in various forms, and these will be defined in the plan document. The plan might allow for annuities only, for example, a life annuity or a joint survivor annuity. Or maybe it'll be an annuity with a guaranteed period. It'll pay for at least 10 years, things like that. It might be a lump sum. The plan might allow the participant to take a lump sum. There could be annuity contracts that's really in the plan and the participant takes the actual annuity contract. Or there could be periodic payments. Again, these will be defined in the plan document. And then we're back to vesting here. We have various vesting schedules to choose from. The longest vesting schedule we can use is 6 years. That's a graded vesting schedule, but we could have it as short as immediate vesting if we want to. And timing of those distributions, assuming that participant is vested, when can they take their money? Well, they certainly can take it when they leave employment, typically, but we can make them wait until they reach retirement age in the plan. Let's say they left employment at 55 and retirement age is 65. It's possible that the plan could hold that money and not let them take it until they're 65, or they might let them take it at 55. And then some plans, typically 401k plans, also allow for in-service distributions, so an employee can access their money and take a distribution even while they're still employed. So I talked about there are safe harbor designs, and then there are non-safe harbor designs. The safe harbor designs will simplify the testing that has to be done on that plan because, as I said, think of them as in-the-box designs, where the IRS is telling us exactly what that plan has to look like to ensure it passes. The most common would be a safe harbor 401k, right? So what do we have that makes a 401k safe harbor? We have a specified minimum employer contribution that must be made. That is required to be made. The employer is agreeing to that. It's written into the plan document. And the amount is defined under the IRS rules. In a safe harbor 401k, for example, it might be a 3% fail-safe contribution for everybody who's eligible, or it might be a match, dollar for dollar match on the first 3% and 50 cents on the dollar for the next 2. Those are the amounts prescribed by the rules that the employer would have to make. Any safe harbor contribution made by that employer is fully vested. No vesting schedule on that money. And by doing that, what do we gain by doing that? Why would an employer want to do that? Usually the reason is that means anybody who's a highly compensated employee is now freed up to maximize their contributions into the plan. So if we're talking salary deferrals here in a 401k plan, if the plan is not safe harbor, the amount that the highly compensated can defer into the plan is controlled by what the rest of the employees do. There's a test that has to be passed. But if we make it a safe harbor plan and give the employees these required minimum contributions, that ensures that anybody who's highly compensated can defer all the way up to the legal maximum, $21,500 this year, regardless of what the employees do. It's a trade-off. It's kind of a quid pro quo, but basically the IRS is saying if you guarantee these minimum required contributions to the employees, then it's okay that the highly compensated max their own contributions out. So again, optional provisions, loans. I had mentioned loans before. Plans do not have to offer participant loans, but they can. You do not have to let the participant self-direct the investments, but you can. In a defined contribution plan, like a 401k plan, you cannot do that in a defined benefit plan. Insurance can be allowed in all of these plans, not IRA plans, by the way, not SEPs and Simples, but a 401k plan, a profit sharing plan, any kind of defined benefit plan can all allow for life insurance. It's considered an investment vehicle essentially in the plan. It's a way to add an added benefit for the employees when that's put in the plan. And then you can also have employer stock in the plan. You know, you think of ESOPs or 401ks. You know, sometimes you'll see money goes into employer stock. These are all optional provisions. Does the employer want to include any of these provisions or not? And the plan would be written accordingly. So here's our third question.
The following question is now launched and should be displayed on your screen. Again, I'll leave it up for about 45 seconds to a minute for everyone to select an answer. I'm going to leave the poll up for about another 15 seconds for anyone who has not selected an answer to do so. The poll is now closed. The correct answer is A, true. And Mary, you may continue.
Okay, thank you. One slide. There we go. Okay, so let's continue with talking about the mandatory requirements here. So let's get back to our plan document. So as we said, the plan changes, you know, could be initiated by regulatory changes, Congress, the IRS, or the plan sponsor may decide to make changes. So who actually has to do the amendments? So typically the amendments will be, that's a change to the plan document, and who wrote the plan document. Usually it's the third-party administrator who writes the plan document. Occasionally, an attorney might be hired to write the plan document for very customized documents. So whoever wrote that original document is likely to be the person writing the amendments. But they just draft the amendments. The amendments must be signed by the plan sponsor. And then they must be placed with the permanent plan records. Now, this is where a lot of these failures occur. I don't have the statistics in front of me at the moment, but every once in a while they come out with statistics, you know, where have failures been in qualified plans and where were penalties assessed and those kind of things. And failure to adopt amendments is way at the top of the list of one of the operational failures of plans. And I know my experience has been, this is, you know, it's anecdotal, this is just me, but I've been doing this for about 40 years, is that frequently those amendments are written and they're sent to the employer, and they sit in somebody's inbox until they get forgotten about. And the employer never gets around to signing them. You know, they're busy doing other things. And ultimately, if they don't get signed, there's your document failure, because the amendment was written, it was just never formally signed and adopted. So it's key that employers pay attention to that when those messages come in and they actually sign those documents and they get put in the plan records. Now, depending on the type of document that an employer has, and we'll talk about this a little bit as we get further into this presentation, there are different kinds of plan documents. There are boilerplate documents, there are custom documents. Depending on what the amendment is, it may need going to the IRS for an approval, right? So there are two kinds of approval letters that the IRS gives on plan documents. You can take your plan document to the IRS and ask for a determination letter. So what is a determination letter? That means that they have looked at your plan document and they give it the stamp of approval. Yes, it complies. They give you a letter saying they have determined this plan document is in compliance. Now, that's a good thing to have. That means if you ever got audited, the auditor would look at that letter and say, okay, I know your plan document is compliant. That doesn't mean it's operating in compliance. That is not the end of the story, but it means your document is in compliance. However, that letter is only officially good for the day it was written. What if Congress had a change and you were supposed to amend your document 2 months later and you never did? that letter that said your plan is in compliance is no longer any good. So when you do those amendments, you would go back and file for a new letter of determination. On some kinds of documents where it's called a volume submitter document, where there's a master document filed by a company, they get an opinion letter. And the difference between an opinion letter and a determination letter is the opinion letter is on that document, which will now be used by multiple employers. A determination letter is specific to that one employer's document. But in either case, when a major amendment is done to the plan, it could be advisable to go get a new determination or opinion letter. The other thing is you have to tell the employees. You know, if you just change the provisions of the plan, the employees have to be notified, right? When employees first come into a plan, they must be given a summary plan description. That tells them what the terms of the plans are in plain English. If there is a major change and amendments are done, then they have to be given a summary of material modifications. Those are the changes made by the amendment, so they're up to date on the changes as well. So what do we have to do? We have certain language. We know there's certain language that is required in the plan documents from the initial day they're written all the way through the life of that plan. We know that certain provisions, the employer will make a choice. Some are mandatory and they must be in that document and they must be upheld in the operation of the plan, and some are optional. Some are, you could do this, but you don't have to, so that employer will have to make those choices. We know that document has to stay in compliance through the life of the plan. You can't just sign that document and stick it in your bottom drawer and forget about it. And when it comes time to amend that plan, the third-party administrator is probably going to be the primary party who gets that accomplished, with some exceptions that if you have a very customized plan document written by a private attorney, you would probably reach back to that attorney to do that amendment. All right, so there's our documentation, our basic compliance, the basic requirements to get a qualified plan. So what type of qualified plan are we going to do? You know, there's a variety of types, and each plan is different. Each employer is different. So we have a range of types, hopefully, to suit different employers' needs and objectives. So here's our listing of plans. We have profit sharing plans. You know, ones that people are very familiar with. Misnomer here, little bit of trivia, right? Profit sharing plans, when they were originally created, to make a contribution to a profit sharing plan, the company had to be profitable. That got changed, I don't know, about 30 years ago. A company who actually doesn't show any profits could still have a profit sharing plan. Just a little technical quirkiness there. Money purchase plans, we'll talk about them briefly. We don't see any money purchase plans anymore, and I'll explain why, or hardly ever anymore, and we'll explain why as we go along. Then, of course, 401ks, the most popular plans that are out there. I could do a little quiz here. Does anybody remember when 401ks first came around? But since we're done with polling questions, I'll tell you it was 1981. So they've been with us for quite a while now, and they continue to be extremely popular. We have standard traditional 401ks, and we also have safe harbor 401ks that are used quite a bit now. And then more recent than that, no, not brand new certainly, we have automatic enrollment 401ks. We're trying to get the savings rate up in this country. New rules were created that rather than when an employee becomes eligible to participate in that 401k plan, they have to choose to elect to defer some of their pay into the plan. Instead, with an automatic enrollment, as soon as they're eligible to be in that plan, they are automatically deferring, and instead they have to opt out. Instead of opting in, inertia tends to take over in large numbers, and so they will save money, the goal being to get savings up in this country. Then, of course, we have defined benefit plans. There are several types of defined benefit plans. They are still very much used. For a long time, the rumor was that defined benefit plans were dead, probably going back into the 1990s here. They are very much alive and well, and still definitely out there. And then we also have the 403B plans. Right, so let's start with profit sharing. So any employer can adopt a profit sharing plan. It could be a sole proprietor, S Corp, C Corp, LLC, partnership, nonprofits, and government entities can also have profit sharing plans. So pretty much any business entity could have a profit sharing plan. The contribution limit is 25% of the compensation of all the participants in the plan. So remember, this is all employer contribution. This is not coming from the employees, it's all employer contribution. It's flexible every year. You can have that plan written so that the contribution is discretionary, which is the great appeal of profit sharing plans. The minimum the employer could contribute might be 0. The maximum they could contribute would be 25% of the total payroll of everybody who's in the plan. So we add up all the payroll of the participants, take 25% of that number. That's what the employer can contribute and deduct on their tax return. Now, once they make that contribution, it's going to be divided, allocated is what it's called in the pension world, allocated among the participants. Everybody does not have to get the same percentage of pay. There are 4 different ways to design a profit sharing plan as to how we're going to split up that money. But when we do that, at the individual level, no employee can receive more than 100% of their compensation up to a maximum of $61,000 in a year. So how can that be? If we have a 25% contribution limit, how could somebody get 100% of pay? Well, that means that somebody else is getting less, right? That's what I mean. We don't have to give everybody the same percentage. Now, we have to go through tests to get there, but we could give employees vastly different percentages of their pay out of that 25%. By that way, that $61,000 maximum for 2022 is going up to $66,000 in 2023, which is the world of pension history, a really big jump. That's a very big jump, and it'll be a nice benefit for those employers who are, contributing to get to the max. No catch-up applies here. Catch-up only applies to salary deferrals. Vesting, we can have vesting schedules here. It could obviously be immediate. The longest we can know is a 6-year graded vesting schedule. 6 years is 0% the first year, then 20, 40, 60, 80, and 100%. So that by the time we finish that 6th year, we're at 100%. If they don't want to use graded vesting, you can do a 3-year cliff vesting. Cliff vesting means you vest nothing year 1, nothing year 2, and then when you hit year 3, it's 100%. You jump from 0 to 100%. You're not grading up like you are in the 6-year schedule. So when can an employer establish these plans? Well, they can establish a profit sharing plan up until they file their tax return, including extensions. They also have up until they file that tax return, including extensions to make the contribution. We here at Pentegra, until very recently, were still setting up plans going back for 2021 for employers who are on extension until October 15th. So that's a long lag time for that employer to figure out what their financial position is and whether it might be beneficial for them to establish something like a profit sharing plan to gain from the deductions and the contributions to their employees. Now, money purchase plans. Money purchase plans have been around for a very long time. Again, they can be adopted by any employer, same as the profit sharing. Any employer can adopt these plans. The contribution limit here is 25%. Now, what was the contribution limit on the profit sharing? It was 25%. At the individual level, when we divide up the money, the most we can give an employee is 100% of compensation up to the $61,000 for 2022, $66,000 for 23. What was the limit in the profit sharing? It was the same. Look at the vesting here. It's the same. The reason we don't see money purchase plans anymore is we used to see a lot of money purchase plans because the profit sharing contribution limit used to be 15%. When they raised that to 25%, suddenly they could match the same amount they could do in a money purchase because the money purchase was always 25%. So it was very common, going back, you would see a profit sharing plan in effect for 15%, and that same employer might have a money purchase plan for 10% because they wanted to get to that 25% maximum. But here they can get to that 25% maximum just in the profit sharing. And what the profit sharing plan has that the money purchase plan does not have is flexibility. In a money purchase plan, there's an actual contribution formula. If we set that contribution formula at 25%, the employer is obligated to make that contribution every year. But in a profit-sharing plan, the contribution is not an obligation, it's an opportunity. So that in any year they could contribute the 25%, but if they don't want to, they don't have to. They could go down as low as 0. So because of that, that flexibility and the same contribution limits, the only money purchase plans we typically see now are ones that are left over, that have been around for a while. I have not seen a new money purchase plan go in for quite a while. They say if someone did want to establish, it would be the same deadline to establish the plan. However, here a money purchase plan is actually a retirement plan. Technically, a profit-sharing plan is not. And so as a pension plan, it's actually a retirement pension plan. The contribution deadline does go with the extensions, but runs out of time on September 15th of the following year. All right, 401ks, right? 401ks, we all know, are really popular. They're out there everywhere. So who can have a 401k? Almost everybody. The exception here is governmental entities cannot do a 401k. They're going to do a 403b, right? They cannot have a 401k. Anybody other than them, including nonprofits, can have a 401k. 401ks, by the way, could be as small as one person, a solo 401k, or they could have thousands of employees. They could be of any size. Salary deferrals. Right now we have salary deferrals from an employee. That's what we've added. A 401k is actually a profit-sharing plan with the added feature of salary deferrals. So employees can defer from their salary. Depending on how the plan has been set up, those deferrals might be pre-tax, or they could also do them after tax as Roth if the plan allows that. A participant here can defer up to 100% of their pay, no more than $20,500 for 2022. So, if they only made $20,500, they could actually defer it all into the plan. That number, by the way, next year is going to go up to $22,500. For those who are 50 and older, that means they turned 50 during that year. They can also do an additional catch-up deferral of $6,500. That will go up to $7,500 in 2023. So this year, if someone is 50 or older, they could actually defer $27,000 into their 401k. Now, these plans can also have employer contributions. They might be safe harbor contributions. They might not. They might be a match. It might be a profit-sharing contribution. The employer contributions come under that 25% limit. So it's 25, so you could do your salary deferral, plus the employer could make a 25% contribution on top of that. So if we simplified that and thought about a one-person plan, let's say someone had $100,000 of compensation, they could do their salary deferral of $20,500 and also receive a $25,000, 25% profit sharing contribution. The 25% does not count the salary deferrals. They don't count towards that. However, on the individual limit, that's $61,000 or 100% of pay. All the money counts towards that, the salary deferral and the employer contribution. The only exception to that is catch-up contributions are on top of that. So if someone is doing a catch-up deferral of $6,500, that could be on top of the $61,000, giving them $67,500. Vesting. Salary deferrals are always immediately vested. Employer contributions, other than safe harbor contributions, as we already discussed, safe harbor is always fully vested, but anything that's not safe harbor can be on a vesting schedule. Same vesting schedule as the profit sharing. We can have that 6-year graded vesting schedule, or we could have 3-year cliff, or of course the employer could also always be more generous. Deadline to establish. 401ks run into a little different deadline. We have the general overruling deadline is the business filing of their tax return, including the extensions, but we have to have time for employees to make salary deferrals. So if the plan is a safe harbor, we're generally looking at an October 1 deadline in the current year to establish that plan, to get the notices out to the employees and enable them to make their salary deferrals. With the Secure Act, we got a new change to safe harbor, that safe harbor employer contributions come in those two forms. I mentioned them before, a 3% fail-safe or a match. This was recently added by the Secure Act that the employer could decide to make their 401k plan safe harbor on the 30th day before the close of the plan year. So, basically December 1, they would then have to make a 4% fail safe. But it would be, if they know they're going to fail the ADP test, which we don't have time to get into here, but this would be a way to convert that plan into a safe harbor at the last minute and save the plan. Employer contributions, if they're doing profit sharing or match, those can go in up until the company files their tax return. The salary deferrals, however, have to be deposited essentially right after they're deferred. For plans with less than 100 participants, the employer has 7 business days to get those monies deposited into the accounts. Large plans get a little longer time. It's as soon as administratively feasible, but not later than 15 days. So I keep referring to Safe Harbor. A Safe Harbor 401k plan, again, can be adopted by any entity except not the government entity, same as the 401k plan. And here we get rid of the ADP test. That's the test that would otherwise limit how much the highly compensated employees can defer. Our deferral limits are the same as the 401k. The only difference here is that we have these required Safe Harbor contributions. That could either be the match, which I already said, a dollar for dollar match on the first 3% of pay deferred, plus 50% match on the next 2%, or a flat 3% for everybody. If it's a 3%, the participants get it whether or not they defer. These Safe Harbor contributions must be immediately vested. The employer can still make additional profit sharing contributions on top of this if they want to, and they would be on a vesting schedule, but the Safe Harbor contributions must be immediately vested. Again, we run into the deadlines of typically October 1 to get this plan into effect. There are some exceptions if you already have an existing plan and you want to add salary deferrals to it. Contribution deadline, we already talked about when those salary deferrals have to be deposited. And then the employer contribution, as I said, could go up to the employer's filing date to get that in. Then we have automatic enrollment. Right? I mentioned that in the very beginning, right? Automatic enrollment means that those employees are automatically deferring as soon as they enter the plan. It's a reverse of the historical way of them having to opt in. Now they have to opt out. We can have this feature in a 401k plan, a 403b plan, or a governmental 457b plan. The mandatory deferral must be at least 3%. This is the Safe Harbor version, right? At least 3% during years 1 and 2, going to 4% in year 3, 5% in year 4, and 6% subsequent to that. You can't exceed 15%. Now, keep in mind the employee can always opt out. They always have the option to opt out, but this would be the automatic increases that would occur that would be written into the plan. Again, you have, if you're going to do you have an employer, if you're doing this as a Safe Harbor, and then we also have a required employer contribution, the matching would be the same as we already said, 100% on the deferrals up to 1% of compensation, plus a match of 50% on the deferrals between 1 and 6%. Or you can go to that 3% not elective. We still have the catch-up available. The contribution limits are still the same dollar-wise, that $20,500, and we also do still have catch-up. And of course, the employee could always choose to defer more than the automatic enrollment. Vesting, again, the salary deferrals are always immediately vested. Here, the employer contribution can have a maximum of 2-year vesting, not that 6-year. Again, we have to establish this plan before the beginning of the year so we can get the notices out to the employees in time for them to make their deferrals. For contribution, the business's tax filing deadline, including extensions for the employer contributions. And again, we have the same time frame for the deposit of the salary deferrals. Now we're going to switch to the other side of the equation. Defined benefit plans, as I said, these are very much alive and well. We write a lot of defined benefit plans. Any employer can adopt these plans. The reason companies would go to these plans is because they have much greater contribution opportunity. We're not limited to that 25% or 61,000 per person. The benefit limit here is based upon a benefit payable at retirement age. It's 100% of pay or a life annuity of $245,000 a year. That will go up to $265,000 a year next year. When we translate that into a lump sum, it's going to be about $3.2 million. So it's a substantial amount of money that we could accumulate for somebody. There are minimum funding requirements here. This is an obligation. This is not like a profit sharing plan, contribute or not contribute. This is a promise of a benefit that's defined by the plan document, and the employer must fund that. We can have up to a 7-year graded vesting schedule here, and as long as a 5-year cliff on these plans. So it's a little bit longer. Catch-up doesn't apply. There are no salary deferrals here. This is all employer contributions. The deadline to establish here, actually it says business tax year end, but employers can actually just adopt these up until they file their tax return, and make their contribution up until they file their tax return. Again, for these kind of plans, when you get into the true pension plans, if they're on further extension, they run out of time on September 15th, 8.5 months after the end of the plan year is when the contribution must be in. But it's still quite a length of time. All right, so we're not going to talk more about defined benefit plans just before I leave them. That would include, because a lot of people don't realize, traditional defined benefit plans, 412(e)(3) fully insured defined benefit plans, cash balance plans. There are a lot of cash balance plans being written out there these days. They are a type of defined benefit plan, so they fall into that same category. So now we're going to 403(b) plans, which are very specific. These are limited to tax-exempt charitable organizations, public school systems, and hospitals. If I'm a private business, I cannot adopt a 403(b) plan. This is the equivalent for these industries to a 401k. And remember, they could adopt a 401k as well, as long as you're not a government entity. And over the years, the 401ks and the 403(b)s have gotten much closer together in terms of their contributions and their features. And where we used to only see 403(b) plans, for example, in school systems and hospitals, it's not unusual to see a 401k instead. That comes down to the details of the employer, but they could do either. That's their choice. They have the option now to do either. The contribution limits essentially are the same. Salary deferrals, same limit of $20,500. Total for an employer, same $61,000 limit. Same catch-up of $6,500. This is the one difference on 403(b). So they have this additional catch-up. For those who have 15 years or more of service at a qualifying institution, they can do up to an additional $3,000 of elective salary deferral a year, $15,000 max for the lifetime. So they can do this extra bit of catch-up to put away a bit more money if they hadn't been doing it all along. That is not available in 401ks. That is only available in 403(b). We have the same vesting, of course. Deferrals are always fully vested, and on the employer contribution, that same 3-year cliff or 6-year graded option. The deadline to establish here is the business tax year end. Again, any kind of deferral plan, you have to have it in place in time to notify the employees. There are notice requirements with sufficient time for them to choose to make a deferral before it can go active. The deadlines for depositing the money are the same as the 401k, and the same thing with any employer contribution here, same as the 401k. Right, we have one more question here.
The poll should be launched on everyone's screen. Again, I'll give you about 45 seconds to a minute to select an answer. I will leave the poll up for about another 15 seconds for anyone who has not selected an answer to please do so. The poll is now closed, and the correct answer was E, B, and C. Mary, you may continue.
All right, thank you. All right, so here's just a nice summary reference chart. I know you'll have reference to this. This is showing the limits just in one place. We have the salary deferral limit, which is for 401ks and 403bs. A Roth 401k, remember, it's still salary deferrals. And remember, in a 401k where you can make Roth salary deferrals, the income limit is not applicable, that it is in doing a personal Roth. So the most that we can defer there, an individual can defer, is $20,500, going to $22,500 next year. Catch-up contribution, $6,500, going to $7,500 next year. The annual defined benefit limit, that's that life annuity payable at retirement age. Retirement age can be defined as early as age 62 or as late as age 65, is a life annuity of $245,000 a year. That will be going up to $265,000. The annual total allocation limit in a defined contribution plan per individual this year is $61,000 to be $66,000 next year. The maximum compensation, this $305,000 is the maximum compensation we can recognize for someone in a plan. They might make $700,000. The most we can recognize is $305,000. That will go up to $330,000 next year. The 457 deferral limit, same as the 401k. The highly compensated employee, this is a salary level that's going to define who is considered highly compensated. It's $135,000 this year. Next year it's going up to $150,000. The Social Security, that's the taxable wage base. This year we're at $147,000. I know I'm giving you all the updates. I forget what that number is going to be for next year. It'll be up a little bit. Simple contribution limit, $14,000. I believe that is staying at $14,000. The simple catch-up is $3,000, and that I believe is going up to $3,500. For set minimum coverage, we're at $650. That's climbing to $750. Same compensation limit. Top heavy. This is a definition of who is a key employee. Again, we also look to ownership, but we look to what compensation is. We're currently using $200,000. There's a look back on that, by the way, to previous years. And the traditional IRA contribution limit, $6,000 going up to $7,000. So just to kind of wrap up, because I know we are just about out of time, we talked about some of the different types of plans, at least the different categories of plan. Granted, we didn't dig down, for example, to all the kinds of defined benefit plans, but we covered quite a bit. We talked about available plan features and those things that are mandatory. Things that must be in a plan, what are you allowed to do for eligibility, things like that. We talked about maximum contribution limits and the obligation or flexibility in making a contribution. So with that, I know we are very close to being out of time. We'll be happy to take any questions, and any that we don't get to, certainly submit and we will answer them in follow-up.
Yes, thank you, Mary, for today's presentation, and we'd like to thank everyone for joining. If you do have a question, you can put that in the question box and we will follow up with you afterwards. Until then, we're going to have an evaluation form that's going to pop up on your screen when you close the webinar, and we greatly appreciate if you take time to take that. And otherwise, everyone have a great rest of your day and happy holidays.